Hey there! Welcome back to the Young Black Professional. I'm Olivia, and I'm so glad you're here. And today we're going to talk about credit. So this is Credit 101. So the first thing is, what is credit? So according to Experian, and I have some notes here just so I don't forget, credit is access to money, goods, or services with the agreement that payment will be made at a later date. If you have credit available for you to use, that makes you the borrower, and whatever the institution that you have the credit available from is the lender. So in the case of a loan, it might be a bank that's the lender with you, the borrower. If you have a credit card, it might be that credit institution that is the lender and you are the borrower. Regardless, when we're talking about you, if you are not in the position to give out money or giving out money to be repaid later, you are the borrower. And the way that lenders figure out who is trustworthy in getting their money is through something called a credit score, which is a compilation of quite a few factors that we're going to discuss, and it goes on to your credit report. So let's get into what makes up a credit score. In this case, we have 5 factors that make up the major credit bureau's credit scores. These 5 factors that make up your credit score are your payment history, your credit utilization, the length of your credit history, any new credit, and the types of credit that you have. So let's talk about each of these, their weight within the credit score, and how they affect your credit score. Now, even though we don't know the exact formula for how each of these are calculated, they are each weighted, and that we do know. So the highest weight is based on your payment history, and it's exactly what it sounds like. When you pay your bills on time, as they come due every month, you can achieve 100% payment history. And most times, I'm going to be honest with you, missing a credit card payment for a few days or so isn't the end of the world. It's most likely not going to go on your credit score as a delinquency, or on your credit report rather as a delinquency. And that's because they tend to just tack on late fees. So if you miss your payment date, don't worry, don't fret. The worst that will hurt is your wallet. Luckily, it most likely won't hit your credit report because they'll just throw on a late fee. How do I know? It's happened to me. And I was gonna freak out. I thought that I was gonna start getting things repoed and whatnot, even though I only owed like 20 bucks on it. But the moral of the story, don't freak out. As long as you are diligent on being on top of your payments and when they're due, you're perfectly fine. Remember, don't be late on your payments, but don't have a panic attack if you are a couple of days late, particularly for credit card payments. Once you start falling behind on car payments and things like that, then you might get into repo territory. If you have long outstanding bills, these could be sent to collections, and once they go to collections is when you can gather a delinquency on your account. And the really crappy thing about delinquencies is that they can tend to stay on your report for anywhere between 5 and 7 years. So that does suck. You don't want to become delinquent to the point where something can be sent to collections, because there goes 35% of the weight of your credit score in the balance of all of your great payments, but also that delinquency that's kind of like a stain on your credit report for almost a decade. So just be really careful and make sure that you are as diligent as possible with your payments. Next is credit utilization, and this is 30% of your credit score. And what credit utilization is how you use the amount of money that you are granted as credit. Now, the amount of credit extended to you depends heavily on 2 factors. The first is your income, and Of course, most creditors are not going to want to give you so much more credit than they know that you can earn, because then they know they'll never get paid back. So they don't want to set you up for failure, but more importantly, as everything in business is, it's self-serving. They don't want to set themselves up to not get paid back. The second is your credit score. So if you have ever looked at your credit history and your credit report and subsequently gotten a credit limit increase as your score has gone up, completely unwarranted as some companies do, they are letting you know that they have seen that you are trustworthy enough for them to want to extend more credit to you, mainly because they want you to spend more money. It's good because then what happens with your credit utilization is once you start to increase the amount of credit you have, you can then start to increase how much you can utilize in a period. Your line of credit is the maximum amount of money you can spend. So it's the max that you are allowed to borrow based on the limits placed on you by your creditors. And if you have ever seen a card get declined, most likely it is because you have either hit that ceiling or you are very close and maybe you've set an alert or a cap on how much you can spend. Alternatively, the card could be frozen, but we'll talk about that maybe in a Credit 102. Once you get a line of credit for any credit card or any just personal line of credit, you don't want to spend more than 10% of that credit line. And why that is because creditors, lenders, whatever you'd like to call them, like to see you stay between the 1 and 10% mark of using all of your credit limit. So the good thing about getting a credit limit increase is that 1 to 10% is now going to increase a little bit. So let's say you had, for sake of ease, a $1,000 credit limit, a line of credit of $1,000. So you would want to ideally spend between $1 and $100, had to think for a minute, of your credit line in order to stay within the good or excellent zone of credit utilization. If you were to get an extension on that credit line to, let's say, $1,500, now your 1 to 10% has moved from $1 to $100 to $1 to $150. And what that does is it gives you more room to utilize your credit and to spend a little bit more on your cards and know that it's not going to negatively impact your report. Because once you even start creeping up beyond 5%, you can start to notice a slight, and it's ever so slight, decrease in your credit score. I like to spend between 1 and 2% of my credit limit in order to keep my utilization really low. The third factor, your length of credit history, is 15% of your entire credit score. And this one and also new credit are they kind of coincide, I'll say. And the reason why is because the length of your credit history is an average length of your credit history. So it averages your oldest credit line and every subsequent line that you've acquired after that. And the reason why, aside from the fact you don't want hard inquiries, which I'll talk about in a second, you don't want to keep applying for new credit, is because it'll start to shorten your credit history. So even if your oldest card has been open for 5 years, if you apply, let's say you have 3 cards, 5 years, 4 years, 4.5. 4.5 years, 4 years. So 3 cards, 5 years, 4.5 years, 4 years. Let's say your average credit history is somewhere, I'm not doing the average, but it's gonna be around 4.5. Okay, it's editing lib here. I don't know why I said I wasn't gonna do the average when clearly I did, and I knew that it was right. Please ignore me. Years. You get 3 new cards in the present day, and now your credit history is going to go down exponentially because half of your cards were acquired in the past week or so. Now, why do creditors like to see that you have a long credit history? Because the longer your credit history is, the more trustworthy you're deemed to be. Because it shows that you've been able to maintain that level of trustworthiness for long stretches of time. And once you start introducing new credit cards, new loans, new charge cards into the mix, it starts to throw off your credit history because it's just an average. Which leads me into new credit. So new credit, which makes up 10% of your total credit score, is equal to the amount of hard inquiries on your account. Now, without getting too deep into hard and soft inquiries, the basic you need to know is that a hard inquiry affects your credit score because you're allowing a potential lender to view your credit report and get access to your credit history. Soft inquiries do not hit your credit report because you may or may not directly be allowing a potential lender to view your credit history. And the most common occurrence of this I can think of would be when you get all of those pre-approved credit card offers in the mail or in your email. That is when a lender has not directly been given access by you to view your credit history, but may or may not have gotten your credit score from some third party or some other method. And the last piece of your credit score, which is also 10%, are types of credit. So this is commonly referred to as your credit mix. And what it means is that you have different types of credit that you have available to you and that you've been utilizing. Now, there are 3 types of credit. One is not very common, and if you can guess, leave it down below in the comments. But they are, and I'll tell you, but let's go on the honor system. If you know it, leave it down below in the comments. If you don't, leave one of those emojis with the monocle. And again, they are revolving, installment, and open. I even had to look because I don't use one of the 3. And if you haven't guessed it, guess now. I'll wait. And it is open credit that is not very common. Now, the most commonly used subsets are revolving and installment credits. So revolving credit is your basic credit card or any personal line of credit extended to you. And what that means is you are allowed to borrow the money to pay for whatever it is that you need to pay for, and then at the end of a statement period, you will owe that money back. And should it go beyond that first statement period, you will then owe interest as well. So the goal is always to not owe interest by paying your statement off in full before it's due or as it's due. Installment credit are your basic loans. So think car loan, think mortgage, think a personal loan. These are all forms of credit where you get one lump sum payment. So instead of just having money available to you to use in the form of a credit card or in the form of a line of credit, you'll get all of the money up front, and the way you're expected to pay it back is in set payments. So you'll have a payment schedule, and you will be paying back the principal, which is the lump sum amount that you've received, plus interest. So that's an installment piece because you pay it in installments. And the last, which is open credit, most commonly refers to charge cards. And charge cards are different from credit cards in that there's no interest to pay. However, there is no interest because you have to pay the entire amount as the statement comes due. So once you get the statement, you will see how much you owe and you have to pay that amount by the due date. There is no interest, there is no I'll just carry it over into the next statement period, because that's not how charge cards work. So that is open credit, and that is far less common than credit cards, revolving credit, or installment credit where you're paying a loan. The best way to have a healthy use of and relationship with credit cards is to start out by paying a monthly bill or a recurring charge with it over one or two cards. So if you have more than one card, maybe one bill each card, or if not, if you have one card, stick to the bill on the one card, because that's a surefire way to ensure that you're actually using the card. With credit utilization, the reason why you may not be seeing your credit go up if you're not using your cards because you just think you have credit, that's great. I'm not going to use it because it's going to be an emergency card or because I don't want to go overboard. You not using the credit is a nothing ventured, nothing gained type of deal. You have to show that you are able to use the credit that is extended to you in a responsible way in order for other creditors and lenders, and even current creditors and lenders, to be assured that you know how to responsibly use it. So that is why you need to try and use your card at least one purchase a month. It doesn't have to be anything extravagant. If you don't have any monthly bills or recurring charges that you can use on your credit cards, pay your groceries with it, go get some gas with it, do something so that you're at least keeping it active and open. Because if you don't use your card for extended periods of time, what can happen is the lender or creditor can then close out the account. And that you don't want, because then that will shorten the length of your credit history. So it's a vicious cycle here we're going through. The trick to having the utilization affect your credit score, though, is that you have to wait for the statement date to come. So if you're charging one recurring charge a month, don't pay it off the same day or the day after. Wait until your credit card statement has generated and that appears on your statement, and then pay it off. This is because creditors and your credit score only recognize the statement date amounts utilized. So if you're utilizing and paying off, it's not really going anywhere. It just kind of seems like a zero-sum game the entire month, because it only hits your credit score once you have an amount within your statement date. Otherwise, you'll just see zero. You won't see any improvement or any diminishing of your credit score. When applying for new credit, be smart about it, because whether it be in the forms of credit cards or loans, hard inquiries are a pain in the neck. And hard inquiries are a pain in the neck because the supposed ideal range for them on your credit report is 0 to 2. 0 to 2. So you'll have to be selective, particularly if you're doing something like getting ready to buy a car and you need to take out a loan for it, and you're going to be going to multiple dealerships or multiple different banks or credit unions in order to try and get a loan, because you don't want all of these people running your report unnecessarily and then having 4, 5, 6 hard inquiries on your report. And that's because they take about 2 years to come off of your credit report. And the last tip, it's something that I don't often hear discussed, so I'm not sure if it's widely discussed or not, but it's freezing your credit. So you can actually freeze your credit reports. I will leave some links down below, and you can read about each credit bureau and how to freeze your report. It's completely free to you. And what that does is it saves you from you, in a sense, if you have a tendency to just keep applying for store credit cards or going out looking for loans, or are just genuinely worried about people running your report. Even though they can't do it without your consent, I can understand the concern, especially when you just never know how shady or shisty people can be. The second reason is because it helps prevent scammers and fraudulent activity. So there's a way to freeze a report with each credit bureau, but you will have to establish a PIN or a password in order to unfreeze it, which is also completely free to you. Ideally, you'll be the only person who knows your PIN or password, and it's also an extra step for any scammers or fraudsters to try and figure out your PIN and then deal with the credit bureau when most people may not know that they can freeze their credit reports and be somewhat safe in that sense. I mean, I think a pretty smart scammer would have to figure out your PIN or your password, because oftentimes when I see PINs, there's something like 15 or 16 digits, and sometimes they're just completely random. So now, the downside to freezing your credit is it's a pain in the neck when you want to unfreeze it sometimes if you are going to start looking for loans for a car, for a house, just for yourself. If you are going to start applying for credit cards again. So let's say you have 0 hard inquiries on your account and you're ready to start applying for more credit cards or more loans, so that way you can increase either your credit limit or the mix of credit you have. You'll have to go through each bureau again in order to unfreeze the account with the PIN and password you established at freezing it. So that can be annoying to some people. Another thing is some people might forget that they've frozen it, especially if they've gone on a stretched hiatus from applying for new credit. So as helpful as it can be equally as tedious to undo those helpful effects when you're ready to get back into applying for new credit diligently and quite selectively. But once you're ready to get back in the game and start adding more credit, whether it be different mixes of credit or just different types of cards or different types of loans to your already existing credit, just be careful and know that there are many pros to freezing your account, but also some equally as annoying cons. That's it. That's it for Credit 101. Thank you for listening to my whole spiel on credit. And if you like this video, let me know. Let me know down below in the comments. Like this video, subscribe to the channel if you're interested in more Money Mondays or other work-related videos and some non-work related videos. But thank you as always. I really appreciate you for watching, for being a part of this community, and that's it. With that, I'm out on this one. Peace.